Milan. Today I will start with housework one, which is more about ratios. It was adapted from the DBE notes, and the information that is given to us relates to the financial records of Veritas. We are given the statement of profit or loss for the year ended 28th or 29th of February. For 2023, we also have the information for 2022, right? This information for now, it is of no use to me until I've read what is required of me, all right? And um, what I can pick up here is that all sales were on credit. So we sell all our sales, all our goods on credit. The markup used for the business is 100% on cost price. The business sells bedroom furniture. All right. Now they want us to calculate and comment on the following ratios. They want us to calculate gross profit on sales. Now, how do we calculate gross profit on sales? These type of ratios, students should nail them because the name of the ratio includes the formula gross profit. Gross profit on sales simply tells you that you need to take gross profit for 2023 and divide it by sales. And that information, you will find it in the statement of profit or loss. For 2023, gross profit is 788,000 and sales is 1,828,000. You will simply take that 788,000 divided by 1,828,000 and times it by 100. Your gross profit will be a percentage, and that will be 43.1%. We also need to calculate gross profit on sales for 2022. So we only look at the 2022 column where our gross profit is 790,000 and sales amount to 1,650,000. To calculate gross profit percentage, you will simply use the formula, which is gross profit on sales, gross profit divided by sales times 100. Gross profit we said was 790,000. Take that and divide it by 1,650,000, and that'll give you 47.2%. Now, in this case, you will realize that our gross profit percentage has decreased. All right. Now, for your gross profit percentage to decrease, it can decrease because your gross profit, first of all, will be way less than your sales. So if your gross profit is less than your sales, note that this percentage will go down. And the only reason your gross profit will go down is because probably your cost of sales were too high. And the fact that your sales are high, it means that the only thing that could result in your gross profit going down is your cost of sales. And another reason might be because your sales decreased from 2022 to 2023 because you were offering discounts, or probably you were selling goods that are not of good quality, or there were other circumstances that were beyond your measure. Like, for instance, in the past 2 years, a lot of businesses suffered because of COVID-19. All right. So you need to make sure that you buy from a cheaper supplier, but you buy good quality goods from a cheaper supplier or an affordable supplier. However, please make sure that you do not compromise the quality of the goods in order for you to have less amount of cost of sales. Now, in this scenario here, you will note that there is a decrease from 47.2% to 43.1%. That's the first thing that you must do when you comment. You state that there is a decrease, all right, from this to that. And the decrease was this much. And now you give us the reasons why there was such a decrease. It can be due to sales prices incorrectly marked, too much trade discount that we offered our customers, or goods sold for less than markup policy. And this might be the case when stock is not moving. Okay, these are the reasons why there was a decline. Now you need to come with a solution. Recommend a solution. What recommendation can you come up with? The business can check pricing and avoid too much discount. And I just need you to understand the certain things that are not set here, but you can include them as part of your comments. Like I told you that probably cost of sales for the current year were too high, all right, which will result in lower gross profit even though your sales are high. But cost of sales will reduce your gross profit. And you need to check competitive, you need to compare suppliers and choose a competitive supplier that offers good quality goods, all right? However, we cannot conclude on that, obviously. We will need to check a ratio that deals with cost of sales. Let's see. All right. The next ratio that they want us to calculate will be gross profit on cost of sales. Gross profit on cost of sales. Okay. And I already gave you solutions for this one. Where we have gross profit on cost of sales will simply be gross profit divided by cost of sales. For 2023, our gross profit was 788,000, and for 2022, our gross profit was 790. But check your cost of sales for 2023. It is 1,040,000, and that obviously was taken as the amount of cost of sales that we were given in our statement of profit or loss, which is 1,040,000. You just divide your gross profit of 788,000 with 1,040,000. And you do the same thing for 2022. You will simply take 790,000 divided by 860,000. Now let's check what happened with our gross profit on cost of sales. And you will notice that our gross profit on cost of sales has actually declined from 91.9% to 75.8%. And the result, when you look at your gross profit, really, there isn't that much difference from 788,000 to 790, from actually 790,000 to 788,000. It declined by how much in this case? I think by around 2,000, which is not that much, okay? So the reason why there was a decline in gross profit on cost of sales is not because of gross profit, but it's because of the denominator, which is cost of sales. And you will notice that for 2023, your cost of sales figure was way, way too high, moving from 860,000 to 1,040,000. All right, which explains why our gross profit on sales in the first question declined. It declined because of high cost of sales figure. Okay, we know that, as I've said, you state what the decline is. If there was an increase or decrease, that's the first thing that you mention when you comment, all right? So there is a decrease from 91.9% to 75.8%. That is the first thing that you mention. Now you explain as to what could have resulted in your cost of sales being, or basically your gross profit being so low or decreasing. The business does not meet their markup of 100% on cost. You can tell for both years, okay? It can be due to prices, well, they've been priced incorrectly. Due to trade discount, goods are sold for less than the markup policy. There is theft, people are stealing from you, or incorrect valuation of stock. Okay. And another reason here that I can mention is that your cost of sales increase might be due to the fact that things are becoming more expensive. Okay. And you're buying from an expensive supplier, and you need to look around to check for cheaper suppliers that will still provide a better quality or same quality of goods as the current supplier. And that's one solution that you can come up with. Remember, I said you mentioned the increase or decrease, you state what the problem is, and you mention what could be done better to improve the situation. Now, here you will simply say the business should check pricing, avoid too much discount, and improve stock control. And as I've said, they must be on the lookout in search of a good supplier that provides good quality goods at competitive prices. All right. The next question wants us to calculate the percentage operating profit on sale. As it says, operating profit on sales. Operating profit on sales will be found in our statement of profit or loss. And it'll include other income, which will be for 2023, it'll be 994,560. And because I said we are calculating operating profit on sales, we will simply take that and divide it by our sales for 2022, which is 1,828,000. And that will tell us how we stand when it comes to, it's actually more about our operating income, all right? It tells us more about our operating income. Is our operating income contributing largely towards our net profit for the year? And for 2022, our operating profit was 983,120. You will divide that by your sales figure for 2022, which is 1,650,000, and find a percentage for that. And when you find the percentage, you will note that for 2023, your operating profit on sales will be 25.4%, and for 2022, it was 29.7%. What could have resulted in this decrease is probably because our operating income or our other income was lesser, all right? It might have been higher last year. Let me just check. Actually, that is incorrect. When you look at our operating income, it has increased. So that is not the reason why this percentage is low. So the only reason, again, that this percentage is lower than last year, it goes back to cost of sales, okay? Because that is the biggest expense that increased between 2022 and 2023. So you will state the decrease and mention what could have caused the decline, right? In this case, we can tell that other operating income is not the reason for the decline. Now, there is a decline from 29.7% to 25.4%. Sales have increased, yet operating profit has decreased. And as I've mentioned, it might not be because of other operating income. It goes back to your cost of sales figure, okay? A large amount of the income is used to pay for expenses. The business should increase control over expenses. And the main expense that we're talking about here is your cost of sales expense, all right? Expenses are not well managed, and that's why I said we need to look for a cheaper supplier who provides the same quality of goods or better quality of goods. All right. The next ratio will be us calculating operating expenses on sales. Now, this ratio simply tells us how much of our expenses are actually contributing to our profit. Higher expenses will result in us earning a lesser net profit at the end of the year, and obviously lower expenses will result in higher net profit for this. So we need to make sure that we control our expenses well. And as I've mentioned so far, when it comes to cost of sales figure, we are not managing it well. And note that it might not only be due to us buying from an expensive supplier. It might be due to other reasons like theft, damage, or stock was simply not of good quality, as I've said, and some of it had to be returned to the supplier. Okay, so all of those contribute to a high value of your cost of sales figure. Okay. Now, when you calculate your operating expenses on sales, as the formula says, it's operating expenses of sales. You will take your operating expenses and divide them by sales. Our operating expenses for 2023 was 530,800. You will divide that by your sales amount of 1,828,000. That is for 2023. For 2022, your operating expenses on sales will be 493,600 divided by 1,650,000 times 100. And when you calculate those figures, for 2023, you will get 29%, and for 2022, you will get 29.9%. There is a slight decline. We just need to make sure that our expenses actually decrease more. Here you can say costs are controlled, are well controlled, because I mean there was only a drop of around 0.9%. Some of you might say, but 0.9% is too little. But what about businesses like Shoprite, where expenses shoot above 100 million? So when you calculate 9% of 100 million, it's quite a lot of money. Okay, it is quite a lot of money. So don't take these percentages for granted. The reason why they express financial statements as percentages is because when you have percentages, it's easier to read financial statement and to make conclusions just based on your percentages. Like for instance here, I know that this company is managing its cost effectively, except again for cost of sales. Okay. In the next one, we are required to calculate net profit on sales. Okay, net profit on sales. We will simply have to take our net profit for the current year, which is 437,060. You divide it by sales for 2023, and sales for 2023 were 1,828,000. And our net profit for 2022 will be 464,520. You divide it by sales for 2022, which is in this case 1,650,000, and you times it by 100. And that's how you will calculate your net profit on sales. For 2023, your net profit on sales will be 23.9%, and for 2022, your net profit on sales was 28.2%. And again, we know that our net profit on sales couldn't have decreased due to our operating expenses, because those were well managed. It could have been due to cost of sales again, all right? Or if it was not because of cost of sales, you need to check what happened between operating profit and net profit for the year. We do have interest expense. Do you see interest expense increased? For last year, it was 30,000. For this year, it was 34,000. Whilst our interest income went up. So for now, two reasons that we know are for sure that could have resulted in this is your interest expense, even though it only increased by 4%. And we can also say operating profit, because, I mean, your operating expenses, because they went up from 493,600 to 530,800. But the thing is, we can't blame that on that, because it goes with cost of sale, with sales. The biggest factor, as I have mentioned before, comes down to cost of sales. Okay, that could have resulted in the decline of your net profit. And your decline of your net profit on sales would have been 23.9 from 28.2. That's a huge jump, and it could have been due to cost of sales. So you will mention that there is a decrease, which is bad. Okay, note that a decrease under operating expenses of sales was good, but here a decrease of your net profit on sales is bad, people. Okay, it indicates that 1.5% is used to pay for finance cost, and that is your interest. Okay, and I have question is, how did they get that 1.5%? They took your operating profit on sales and they compared that percentage to your net profit on sales. Another way of having done this was simply to check the percentage. I could have just taken the percentage, calculated my finance cost on sales, and that could have just given me an idea of how much of my finance cost actually, how much of my sales figure actually goes to my finance cost. And I think that was a good way of comparing the two. Okay. And I don't think this is a good idea. So we need to also manage our loans well, since we are incurring high finance cost. But as I have said, even though they blame it more on finance cost, the biggest factor here was cost of sales. And you realize that once we calculated cost of sales from sales, that's where the problem started. We do not manage our cost of sales effectively. All right. And so that's what we need to pay more attention on. Because when you look at your interest expense, it only increased by 4,000, and 4,000 isn't really that much. Now, the next one will be us calculating solvency. Okay, solvency simply determines the company's ability to settle its liabilities. It's all about the longevity of a company. So when you calculate solvency, it'll be total assets is to total liabilities. And that information, we will find it in the statement of financial position. Your total assets for 2023 were 2,776,660, and your total liabilities for 2023 amounted to 400,000 plus 129,600. That will be 529,600. So for you to calculate your total liabilities, you took your non-current liabilities of 400,000, you added them with your current liabilities of 129,600. Okay. And as I've said, that will give you 529,600. Now, for me to make sure that my liabilities are expressed as one, all I did was to divide both sides of the ratio by the right-hand side of the ratio. So I took that 529,600, I divided it by 529,600, and then went to the left-hand side, which is your total assets. I took that 2,776,660, and I divided that by 529,600. Okay, let's see. So you will say 2,776,660, divide that by 529,600, and that will give us 5,2. All right. So it tells you that for each liability, we have 5,2 assets. For all our liabilities, for each of our total liabilities, we have 5,2 assets, which is actually more than enough to cover for our total liability. So our solvency, for so far when it comes to solvency, we are safe. All right. We are not of high risk. We are not highly indebted. We can continue for foreseeable future based on this, because remember, total assets represents it represents future, it represents potential economic benefits. All right, simply things that will help you, things that you own that will help you generate money for the business or any economic benefit for the business. So if future economic benefits, potential economic benefits are more than future claims over the assets, you are in good standing financially. Okay, and when you look at your solvency ratio for 2022, it is 4,1 is to 1. Now, what has happened, and you will note that your solvency ratio has actually strengthened from 4,1 is to 1 to 5,2 is to 1. So it's improving from 2022 to 2023. It has improved. And you have to mention that as part of your comments that your solvency ratio has actually improved. That means for every one liability, for 1 rand of a liability, you'll have 5,2 rands of your assets. Now the business is insolvent. It will be able to settle its long-term liabilities. And then you can calculate your current ratio. Guys, ratios are all about you remembering the formula and what each formula represents. Current ratio stands for the company's ability, determines the company's ability to settle short-term debts using short-term assets. By short-term, we mean assets and that can be converted into cash within 12 months. By short-term liabilities, we mean liabilities that need to be settled within 12 months. All right. Don't say that when they ask you what does short-term liabilities mean, don't say that these are liabilities that are of short-term. No, you're not saying anything. These are liabilities that will be settled within 12 months, and that is the short period of time. And this financial year, please note that it differs on the type of business that you've got. And IFRSs allow you to have a financial year that is more than 12 months. So be careful. While for now, for grade 12, you can't just focus on 12 months. But when you go to varsity, be careful and note that not all businesses' financial statements are for 12 months. Okay. For us to calculate the solvency, the current ratio, we will simply take this year's current assets, which in this case amounted to 732,660, and this year's current liabilities amounted to 129,600. So this will be 732,660 for the current year is to 129,600 for the current year. And for last year, it will be 398,600 is to 229,600. And that's how you will calculate your current ratio. It is your current assets to your current liabilities, your current assets to your current liabilities. And when you calculate it for the current year, it will be 5,7 is to 1 for the current year. And last year, it was 2,9 is to 1. Now, it has improved, meaning that the company has found ways to make money or to have liquid assets, because these are liquid assets, and the most liquid asset will be your bank. Why do we say they're liquid? It is because they will be converted into cash or its equivalent within 12 months. And your ability to settle short term has improved. Last year, for each liability, your current assets amounted to 2.9 rand. For each 1 rand of a liability of a current liability, your current assets amounted to 2.9 rand. This year, for each current liability, for each 1 rand of your current liability, your assets will be 5.70 rand. So it has improved. You need to state that when you comment that the ratio has increased from 2,9 is to 1 to 5,7%. And that is good, okay? Because we're talking about liabilities are to your assets. And some might be confused as to how I got that 5,7 or how I got that. I will calculate, this time I'll calculate it for last year, okay? For me to get the one that is under current liabilities, I took 653,600 and I divided that by 653,600 and it gave me 1. That's the one that I have on the total and on the current liability side. Okay. Oh no, this here is all about the solvency. Why am I doing solvency? Now let me just go back to liquidity, not liquidity, but current ratio. So for my current ratio, I took 229,600. You will divide that by 229,600. That's the one that you have on the side of your current liabilities. So it'll be 229,600, and that'll give me 1. How did I get the 2,9 that is on the side of your current assets? To get that, all I did was to take my total current assets, which were 665,600, and I divided that by 229,600. That's how I got the 2,9, and you will need to change it to a decimal, and that will be 2,89. Rounded off, it'll be 2,9. So that's how you calculate the ratio, guys. Okay, it's always the right hand side divided. You divide all the sides, both the left-hand side or the first part of the ratio and the second part of the ratio will be divided by the second part of the ratio. That's what we normally say in math. The first part, which is your current assets, and the second part will be your current liabilities. So both the second part and the first part will be divided by the second part. And I've explained that where I took the first part, which was 229,600, and I divided it by 229,600. And I took the second part, which is 665,600, and I divided it by 229,600. And that's how I got the 2,9 that is in the first part. In most cases, they will ask you to write it in two decimal places. And if you were to write this in two decimal places, it'll be 2,90, which really doesn't make that much of a difference. Okay. Now, the reason they gave us when we commented is that this means that for every 1 rand of the current liability, which is a short-term debt, the business has 5 rand, 70 current assets to pay for it. The high ratio is an indication that the stock levels are very high and that too much cash is tied up in stock. Well, we don't know yet. For us to be able to know that, we will need to calculate acid test ratio, all right? The business should check the stock levels are not too high, check if obsolete stock, and whether the prices are too high. Please note that under current assets, you have cash and cash equivalent, you have trade and other receivables, and you will have inventory. Do not assume that just because your current ratio is high, it is because of inventory. It could have been because of trade and other receivables. Trade and other receivables relates to people that are owing the business. Now, in recent years, people have been facing serious financial distress. Now, people cannot be able to settle or service their liabilities. And at the moment, customers in South Africa, consumers specifically, are highly indebted and they cannot pay off their debts. And that could be the reason why you have a high current ratio. It might be because your debtors are not actually paying you back because they're facing serious economic climate. There's a serious economic climate in South Africa, and this economic situation in South Africa affects their finances and they're unable to service their debt. That means your money is tied up with debtors because you actually bought stock and you gave it to your debtors. And if you don't get that money back, you might face serious financial implications. All right. So I need to specify that even though I wrote it as comments that it might be due to stock, it's not only just due to stock. It might be because the business cannot collect its debts, or it might be because the business have a lot of money that it puts in the bank and it's not using it. All right. And we can mention a lot of businesses that have a high cash flow, high cash in the bank that they're just not using. And that we call it an opportunity cost because that money is tied up, it's sitting there in the bank, whilst you could be using it for other things, for expansion, for instance, or investing it in alternative businesses. Because remember, in business, you cannot put all your eggs in one basket. All right, moving right along. Now let's calculate acid test ratio. The formula for calculating acid test ratio is you taking your current assets, you minus your liabilities is to your current liabilities. Remember, this ratio specifies as to whether would you be able to settle your current liabilities if you didn't have inventories, if you didn't have trading stock, which is what a lot of businesses were facing during the COVID-19 era, where a lot of businesses were not selling and they had to close down because there were no other alternative ways of making money. Now, this ratio simply tells you where are you standing if you will not be able to have your trading stock. Would you be able to settle your current liabilities? And that's what a lot of businesses struggled with. And because of them relying too much on their inventory or trading stock, they were forced out of business because current liabilities, current lenders wanted their money, and most businesses didn't have money. You are simply going to take, I will simply do it for 2023. So for 2023, you will simply take your current liabilities, and that information, you will find it in your statement of profit or loss. You will take your current liabilities. Your current liabilities for 2023 amounted to 129,000. Your your current assets amounted to 732,660. But of that, wow, 420,800 was for inventory, which makes sense as to why they said the comment that they said earlier on. This business, Veritas, holds too much stock of the current assets. 420,800 was on inventory. It holds too much stock. And note that holding too much stock comes with holding costs. On top of that, it can go absolutely, it can be easily stolen. A lot of things you need security guard, which is part of holding cost. If it's perishable goods, you need fridge. And now we're facing load shedding and stuff. Okay, so all of those things could actually impact on the business negatively. You do not want to hold too much stock. And let's see where it will take us when it comes to the acid test ratio. The only difference between the acid test ratio and the current ratio is that with the acid test ratio, you will take your current assets and minus your inventory. And your inventory, as I've said, for 2023 was 420,800. You subtract it from your total current assets of 732,600. And that will give you 311,800 is to your current liabilities, which were 129,600. To simplify this ratio, you will divide both parts of the ratio by the second part of the ratio. I will start with the first part of the ratio, where I will take 129,600 and divide it by 129,600. Equal sign, it will give me 1. And the second part of the ratio will give me how much? 311,800. You'll still divide it by 129,600, and that will give you, as a decimal, it'll give you 2,41 in 2 decimal places, or simply 2,4 in 1 decimal place. This is good though. It's still good because it means that even if you don't have your inventories, you'll still settle your liabilities. However, when you consider that the current ratio was 5,7 is to 1, and that indicates that, let me just calculate it quickly, that indicates that 5,7, when you take that 5,7, 5,7, you minus 2,4. The difference between these two ratios will be 3,3. Wow, that means 3 rand of your current assets is tied up in trading stock. Remember, trading stock is just sitting there in the warehouse. Okay. And this is what a lot of businesses do in most cases to manipulate their financial statements. They just put a lot of trading stock on, they manipulate it and claim that they have so much trading stock in their warehouse. I need you guys to watch Steinheim's, and you will see how easy it is to manipulate financial statements so that you can get loans, you can be able to buy on credit, and you can get some investors like Warren Buffett, who doesn't believe in a business that has too much debt. And we'll talk about that when we get to the solvency, not a solvency ratio, the gearing ratio, all right, which indicates there is debt to equity ratio, which indicate how indebted, how risky the business is. And a business that has low debt to equity ratio is considered to be less riskier than a business that has high debt to equity ratio, but we'll discuss that later on. Let's calculate the acid test ratio for 2022. And it looks like even for 2022, the business was holding too much stock because it declined, but not that much. It declined from the current ratio for 2022 was 2.9 to 2.4. So in 2022, the business did not hold too much stock. It just decided to hold too much stock in 2023. Okay, there's a huge jump still when you look at your acid test ratio. It's double last year's one. So it's not solely because of inventory that our current ratio was higher for this year than last year. It is because of other current assets. Because when you look at the jump of acid test ratio, this is where you calculate the current ratio without inventories. It's still twice last year's. And that is quite a lot. Okay. The ratio increased from 1.2 is to 1 to 2.4 is to 1. This means the business can pay its short-term debts without having to sell stock. But you need to be concerned because it's it's obvious that it's holding too much stock. Most of its money is tied up in stock. And that money that is tied up in stock, as I've said, I spoke about where you make sure that you diversify. Diversify simply tells you that you cannot put all eggs in one basket. So you can use that money that is tied up in inventory and invest it elsewhere where it earns interest, because when trading stock is just lying there in the warehouse, it's not really earning that much interest. It's not earning interest at all. Instead, there's an opportunity cost that you're losing. An opportunity cost is the potential of income you could have earned if you invested that money elsewhere. That's what opportunity cost is. And the opportunity cost in this case will be high if you keep on holding too much stock. But for us to figure out if indeed we are holding too much stock, we'll have to calculate what we call stock holding period and see how often do we convert our stock into cash by calculating the stock turnover rate. For now, we will simply do what we call our average debtors collection period. How do we calculate average debtors collection period? The formula for this will be your average debtors divided by credit sales. You times it by 365 days. It can be 12 months if they want you to indicate it in terms of months. What is average debtors? Average debtors will be your trade debtors for this year plus last year. You add them, and then the answer, you divide it by 2. It'll be trade and other receivables for this year plus last year. You get the answer divided by 2. Credit sales, obviously, you need to take your sales, and they will normally tell you what percentage of your sales will be credit sales. For this question here, they specified that your credit sales will be 100%. So all your sales are on credit. And let's see our trade debtors. We are given trade and other receivables of 159,660, and for 2022 it was 156,600. You will simply take that 159,660 and divide that by, actually you will add it with last year's one. Okay, you will add it with last year's one, which will be 156,600, and divide them by 2. So you add them and then you divide them by 2. By that, I simply mean this because a lot of students make a mistake of multiplying like this, where they take 1 divided by 2 and they multiply it with, they will normally multiply it with 159,660, and then they add 156,600. Please note that you may not do this. You need to put these in brackets You need to put them in brackets. If you're doing maths, you should know. Even if you're doing math lead, actually, you should know because you did this in grade 8. You put them in brackets because that half will be distributed to both of them. And when you just multiplied by half, you only multiplied the first term by that half, and it needs to be distributed into the second term as well, which is what you didn't do. And this is what we will have as our average debtors, right? Which is trade and other receivables. And we will simply take that and divide it by our total sales, which amounted to 1,820 something. I remember doing that earlier on, which is 1,828,000. And you times it by 365, it'll give you 31,6. This is debtors collection period. It takes you a whole month to collect your debts from debtors. That is for 2023. So remember, you take trade and other receivables at the end of the current year, you add it with trade and other receivables at the end of last year or the beginning of the current year, because whatever you ended with last year will be the opening balance this year. I don't care how you take that, but if you take it as closing balance for last year, I'm still good. If you take it as opening balance for this year, I'm still good. You add them and then you divide them by 2 or simply multiply the answer or the sum that you get by half. Then you divide it by credit sales. Know that if they said credit sales were 50% of total sales, I was going to take that 1,828,000 and times it by 50%. And that's what I was going to divide that by. Okay, so my denominator was going to be half of that. Okay, but here they said all sales are on credit. Do the same thing with 2022. Please note that for 2022, your trade and other receivables was given to you under additional information. So you will take this 169,400 and add it with that 156,600, if I'm not mistaken, 156,600. The answer you divide it by half and then you divide it by total sales or credit sales for 2022, which is 1,615,000. Let's see what our debtors collection period will be. It will be 36,1. So it has decreased, which means we are being a little bit effective in collecting our debts. And when we fail to collect our debts, we normally hire debt collectors to do it for us. But for now, it looks like we're a little bit on point because collecting your debts within 30 days is good. Because remember, normally your creditors will take you around 60 days to pay them back. So whatever you collected from debtors, you can take it, buy more stock so that you can sell it. But you need to make sure that you sell that stock so your stock turnover rate must be higher because you don't want to hold too much stock. Note that the higher the stock turnover rate, the lower your stock holding period. Just remember that. Okay. State when you comment that it has decreased, which is good when it has decreased. It's an improvement. Okay. It is an improvement. Guys, note when you comment whether the increase or decrease is good or bad. Okay. Please note that if we were dealing with the current ratio, the increase was going to be bad. Okay, not the current ratio, operating expenses on sales. Sorry, the increase on operating expenses on sales was going to be bad because it means that you're incurring more expenses. Whilst when it comes to debtors collection period, it's good. When it comes to current ratio, it is good. So be careful what each ratio represents. Here it tells you how often do you collect your debts from your debtors. So you want that period to be as short as possible. You need that money back as soon as possible so that you can use it to cover all the business expenses. Okay. The debtors are paying their accounts quicker. Encourage debtors by offering discounts for early payments and charge interest on debtors who take more than 30 days to settle their accounts because you need that money back as quickly as possible because you need to pay off your creditors between 60 days and 90 days. Next one is what we call creditors payment period. Creditors payment period indicates how long it'll take us to pay our creditors. Normally it should, to be safe, it should take us 60 to 90 days. But if it takes us less than that, it's still good, but that'll be it'll be bad negotiating wise because it means you didn't negotiate well with your creditors because you want to take as long as possible to pay your creditors in case your debtors don't pay you on time, or you can take the money that you get from debtors and reinvest it into the business to generate more money using that. And then when by the time you paid back, you only paid with what you have earned and you still have your investments in line. All right. That is the point of it all. And your creditors payment period will be calculated by taking your average creditors, you divide them by credit purchases. Your average creditors here will be your trade in other payables for the current year plus trade in other payables for last year. So it's opening balance of trade in other payables plus closing balance of trade in other payables. You find the sum and then you divide it by 2 or times it by half. It's totally up to you as to which one you will follow. And when it comes to credit purchases, I need to check how my purchases were made, and normally purchases will be, the information about purchases will be cost of sales. Okay, so cost of sales for the current year were 1,040,000 and for last year will be 860,000. And I need to find out how those costs, or basically the cost of stock sold, was financed. Was it financed by cash? In this case, point number three says that it says that the markup used by the business is 100% on cost. The business sells bedroom furniture. They don't specify actually as to whether all our purchases are on credit or all our purchases or just part of them were. Okay, let me just see. Okay, they're missing that important information. For now, I will assume that all our purchases for were on credit. So 100% of our cost of sales represents credit purchases. When we calculate our credit purchases, I will simply use the whole cost of sales. Now, trade in other payables for this year plus trade in other payables for last year. How does it work? Let's look. That information will be found in your statement of financial position, your undercurrent liabilities. Trade and other payables for this year amounted to 129,600. You will add it with 229,600 and divide the answer by 2, and then divide the whole thing by your credit purchases for this year. And your credit purchases for this year, I said it will be 100%. All your cost of sales will have been purchased on credit. For this year, your cost of sales amounted to 1,040,000 and times everything by 365. So it'll take you 63 days to pay your creditors for this year. Let's see how long it'll take us. For last year, it was 97.6. Now, the fact that we are paying our creditors way faster, it's good because then if we take long, our creditors will charge us interest. But we need more details to see if it's good or bad. If our creditors are not charging us interest, if we pay them in less than 100 days, then it will be a bad thing for us to actually pay our creditors within 60 days because we could have just taken that money, bought more trading stock, and then paid in 90 days. You don't need to rush to pay your creditors as long as your terms and conditions allow you to, and you won't get charged interest. Immediately when you get charged interest, know that you as the business, your internal controls are wrong and you failed to negotiate effectively. And well, that's why I'm saying it depends. Now, read the scenario very well. You will be given more information in the exam. Read the scenario very well because you might say it's good, but it's not always good. If the creditor allows you 100 days and in those 100 days they don't charge you interest, then this is bad. Because why rush to pay them back when you can actually take that money, use it within the business to make more money? And by the time you pay them with more income that you made by taking the money that you were supposed to pay them and investing it. I hope I'm making sense. Okay. For instance, if your mom gives you 60 Rand and she asks you to pay it back in 2 months' time, how about you take that 60 Rand for this month, you buy some sweets or you do whatever, you sell, And instead of retaining it month end, that 60 rand, you take it, you buy more sweets to sell. By the next month, you will have made 120. And by the time you pay your mom after 60 days, you only pay her with 1 month's profits. Done. And you still have the other 60 rand that you can still reinvest by buying more sweets and making more money from it. Okay, that's what I'm simply trying to explain in this scenario. The period decreased from 97 to 97.6 days to 63 days. The business is paying the creators quicker. The business receives payments from debtors before they pay the creators, which is good for the cash flow of the business. Paying within the credit terms leads to credit worthiness on obtaining interest from creditors. As I've said though, if your creditor doesn't charge you interest, then pay them within 100 days. If they charge you interest, then you are forced to make sure that you meet those payment dates, which is 63 days. Normally they allow you 60 to 90 days. So read the terms and conditions of the credit agreement thoroughly. Now let's calculate stock turnover rate. Stock turnover rate and your stock holding period are quite similar. And a lot of students make mistake. Note that with stock turnover rate, you don't multiply by any 365 or multiply by any 12 months. So it is simply your cost of sales divided by average inventories. All right. And I need to specify average inventories is inventory for this year plus inventory for last year. Now, there's a question that I did on the cash flow statement where they said to you, how long will it take for the business to sell its closing stock? I repeat, how long will it take for the business to sell its trading stock? Note that in that scenario, you cannot use average inventories. Your denominator will just be closing stock because they are only interested in the value of your closing stock. How long will it take to sell only their closing stock? Or if they don't say the closing stock, they will say, how long will it take for the business to settle its, actually to sell its trading stock amount that we have at the end of the year? Okay. Now, they're not saying the entire trading stock. They only specify the one that you have at the end of the year or this year's closing stock. Immediately when they put such words, this year's closing stock, the inventory we have at the end of the year, only the end of the current year, the end of the current year, closing stock for the current year. You don't use average. You only use the value of your closing stock at the end of that specific year because they're not interested as to how long it will take for you to sell this year plus last year divided by 2. No, they just specify, they just zooming into this year's stock. How long will it take you to sell this year's closing stock? Not the entire, this year's only. And that's why you won't use average there. You will just use this year's closing stock. But here, obviously, I'm not doing that. I just want to know how long will it take for you to settle, to pay, to turn all your inventories into cash. So you will use average inventory. This year's inventory, you should know by now, we had them under acid test ratio. This year was 420,800. Last year, it was 398,000. We divide them by 2. In your numerator, you'll have your cost of sales. Your cost of sales were 1,040,000. So it'll take you 2.5 times per year. Okay, we'll discuss that because it also depends on the type of business that you have. For last year, our stock turnover rate or rate of stock turnover was 2.3. So it went up, which is good because you want to convert your stock into cash many a times in a year. Right, you want to convert it into cash many times. So this is an improvement and it is satisfactory for a business that sells. That's why it's saying it depends on what type of business you are in. If it sells furniture, it's reasonable because normally your furniture, it will take you it's around 6 months. That's a lot, okay? When we round it off, it'll be 3 times, which is every 4 months. For furniture, I might say a safe space for furniture. Well, it depends again what type of business you're running. Because if you're selling high-end, high-quality, expensive furniture, then this is reasonable. But if it's like your okay furniture, then this is bad because it should actually take you around 2 to 3 months, which is normally 4 times in a year. Okay. But for businesses like ShopRite, this is way, way too small because ShopRite converts tens its inventory into cash pretty much every day or every 2 weeks or every week. All right. Please note that for last year, when you calculate your average inventory, your inventory's balance for last year was given to you under additional information. Know that last year of 2022 will be 2021. So the previous year, the year before 2022 will be 2021. And for 2021, your inventory or trading stock was 360,000. And you're going to add that with the 2022 inventory of 398,000, if I'm not mistaken, divided by 2. And the numerator will be cost of sales. And your cost of sales for 2022 was 860,000. This is an improvement. And as I've said, it's not guaranteed that this is good. So when I say 2.5 times, you can't say it's good. You need to look at the type of business that you've got. For instance, for vehicles industry, if it was once, and you're selling like your Ferraris, your Lamborghinis, by selling just one in a year, it's a huge improvement. Okay, so you need to look at the type of business that you're given in a specific question for you to judge whether it's good or bad. But an improvement in stock turnover rate is always good. A decline is always bad because you want your rate of stock to be higher, to increase, as it indicates that you're selling your stock faster. Selling stock, remember, doesn't always have to do with the cheaper stock. It's affected by a lot of things: your marketing expense, your advertising expense, your quality, your packaging. All of those things affect the rate of stock turnover. So this business might have done well or improved in certain instances, but it to improve by 2 times, it's actually decent, all right? But for a furniture business, is it really satisfactory? It depends on what type of furnitures they're selling, as I've said. Okay. I'm talking about furniture. You will remember Goma Goma in Steinheist. Guys, please make sure you watch Steinheist. It's such an interesting, I don't want to say serious, but it's a very interesting show actually. Shows scandals, how people manipulated financial information. One man, as a matter of fact, who is a CA, and it also shows you how powerful the chartered accountancy designation is. You don't just fool South African accountants, you also fool international accountants. I don't know how rich people operate, where they just trust one person and they operate business based on trust, and they don't even check what is happening to their money until everything is gone bad. Interestingly, one person who is a financial analyst noted what was going on. And we have how many actuaries in South Africa? We have how many quants in South Africa? People that have done maths thoroughly, PhD, masters that are working for big banks, and none of them are actually arguing against this guy that found a mistake. I wonder if what qualification he has. Is it CFA or Chartered Accountancy? I just wonder. And just watch Steinheist and you know what I'm talking about. Before I deviate, let's get to this quickly. Let's calculate stock turnover, stock holding period. You don't want your stock holding period to be too high. And you note that your stock holding period formula is the same as your stock turnover rate, except that they are in reverse. Did you realize that they are in reverse? Again, if they ask you how long will it take to hold stock at the end of the current year, please note that you will only use inventory for the current year only. You don't calculate the average. Guys, read the question carefully because it guides you as to what it wants. But if they don't mention, they just say stock holding period, then you just use the normal formula, which is your average inventory, which is inventory for this year plus inventory for last year. You divide it by cost of sales. We did this above, and then you times it by 365. Sometimes they will want it in months. So if they want it in months, you don't times by 365, you times by 12. Okay. For this year, we hold in stock for 143. We want this to decline, actually. We don't want to hold stock too much. And it makes sense why it's declining. It's because your stock turnover rate is high. That's why I said these two should be the opposite of one another. You can't have a high stock turnover rate and then have a high stock holding period. That doesn't make sense because stock turnover rate simply says you're taking stock that you're holding and you're turning it into cash. That's what it means, right? Now, this actually makes sense. That's why it's declining and improvement. It's good. But I feel like 143 days, that is more than 3 months, more than 4 months. Let me see. It's 3, 6, 9, 12. Well, it's more than 4 months, which is a big deal for me. I feel like this is still too high. But your furniture doesn't go obsolete. That could be the reason why it's not a big deal, but it runs out of fashion. But someone can say, but classic is what counts. That's what customers need. That's why we have businesses like Coralcraft that sell classic furnitures, that are selling classic furnitures. That's why we have companies that are producing, is it Smack or Mac? Or yeah, Smack or that. That expensive fridge and things that uh, they look vintage. I don't know if they are nice, but they look vintage, but they cost a lot, okay? So that's why I'm saying it really depends. But in this case, you really don't want to hold too much stock for too long, okay? And as you hold too much, someone say might be a benefit because it turns into vintage and vintage will cost more as time goes. But no, especially electronic stuff, you don't want to hold too much of that. Okay. It's still a long time, as I've said. According to me, it's still a long time. The business can look at a better buying policy or strategy to increase sales. Okay. And then the last one, which is debt to equity ratio, which is simply your liabilities is to shareholders' equity. Liabilities is to shareholders' equity or owners' equity. Owners' equity, remember, is made up of share capital as well as your retained income. In this case, I did not give you your share capital. I only gave you capital just to link it to other types of businesses. But capital, it doesn't change at all. Okay. And your capital information will be found under equity. And there it is. For this year, it is 2,247,060. For last year, it was 2,008,000. All you have to do is to compare this to your long-term liabilities, right? And that's how you calculate your debt to equity ratio. Your debt to equity ratio indicates how risky a business is. So it's your non-current liabilities is to your owner's equity. For this year, it was 0.18 is to 1. And for last year, it was 0.21 is to 1. So it has declined. And the decline is pretty much good because it simply indicates that the business is relying less and less on debt financing in the long term. And I feel like it's very good because it says that for every 1 rand of equity, there's only 18 cents of liabilities. So the business is financed for every 1 rand of owner's equity. In a way, business is financed through equity. For 1 rand, the liability part will only be 18 cents. So this business doesn't rely more on debt, which is what Warren Buffett is more interested in. He is more interested in businesses that are less risky, and he believes that less risk is indicated by less indebted the business is. So a lot of people don't know what Warren Buffett is. When you talk about the richest man in America, they all think of Elon Musk, they think of Bill Gates, they think of the Gucci guy just selling ugly things that rich people are just buying. Yeah, Gucci is really, really ugly. Especially when you see people that are wearing it and they put a belt there and then it's no fashion style at all there. But I guess money is fashion these days. It's not about what looks good on you. Anyway, so what I was trying to indicate is that Warren Buffett is an investor. Okay, He looks at businesses that are small, buys them and sells them later on at a higher price. Then that's what he improves them, and that's how he started with his company. It was an engineering company, and he turned it into investment company. It's something Hathaway. I forgot the name of the business. Um, was it on medical things? I forgot. Okay. But that's what he does. Okay. He buys small businesses, develop them, and then sell them to the highest bidder. And that's how he makes his money. But he doesn't invest in a business that is highly indebted. High debt in the business world is considered to be high risk, which we normally show as standard deviation, or which is the square root of your variance. When you do finance, you will know what I'm talking about. So since you're in matric, go and do something they call finance or become a quant analyst. Be a proper one, not the one that will not even notice that a company like Steinhoff is going down. Only one quant analyst in the whole country. Yes, South Africa. Ah, anyway, I can't blame just South Africa only. We have people in Wall Street that companies went down. I think there's a recent company bank in the US that went down. And you ask yourself, where the hell are the analysts? And there's a Madoff guy that was using, like, he was basically, it's like a pyramid scheme. You need to watch that series as well. It's Madoff, I forgot the name. I always forget these things. But anyway, check them out. And you will realize it's not just South African analysts, and these are educated guys with maths that are proper, eh? But they miss little things. They miss things that they are supposed to pick up. Like how many actuaries? Do you know how difficult actuarial science is in South Africa? And then you have one person that noticed that there's something wrong with Steinhoff, one person. And how many analysts do we have in JSE? Actually, I would close all of them down. And funny thing is that these people don't want to hire youngsters, and you have old people that are there, and they always point at government, or everyone in parliament is over 65. But when you look at those companies and analysts, it's people that are way too old, and they fail to pick up things that they are employed to pick up. All right. I don't know about Tebe investment. When you watch this series, they talk about them identifying it, but why did they keep quiet? And why were they not asking questions? And where are the lecturers? Lecturers normally, these as high school teachers, but didn't they teach their kids that there's something wrong there? Why is it that people that are really, really smart in South Africa didn't pick those things up? Because that's what it means. You're good in math, you're good in analysis, you're good in finance. Why couldn't you pick it up? Isn't your research all about that? I mean, we have professors that establish researchers now and then. How come no one noticed it until government loses billions of government employees' pension? And yeah, question is, are they going to get it back? That is the most important question. Okay, so money was wasted there in Stellenbosch somehow. All right. And yeah, I did say that it's a good improvement. However, I don't think this company relies on debt financing. It's very low risk, which is low gearing. It's credit worthy, and the bank will consider a loan to the business. I hope you guys will become good investors. Finance is the thing to go, and be a chartered accountant, not a useless one, a good one. Okay. Please try out this exercise. Try out that, and you need to calculate this. I'll just give you a few for now, and this dividends and the true value of a company, which is your net asset value. And you will be shocked how Marcus used to manipulate a financial statement to make sure that this is higher. Yeah, CA are smart, and somehow all the CAs were fooled by one guy. Anyway, Khotsong, thank you for watching and enjoy accounting. Kilebile Minahani, Pretoria, Cape Town, Joburg, thank you for your support. I see that East London, you're coming through, and I'm hoping that Ekurhuleni will also come through and support. Watch my channel. Please don't forget to subscribe, like, and subscribe. Khotsong.